And there you have it. The markets are officially closed on this Friday, December 6th. Welcome, investors and traders. I'm AJ Monte, and this is a 3-month daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. As you can see from this chart, we have a lower high and a lower low today after the pivot point yesterday. So we have a continued downward move in the Dow, with the stochastic down below is crossing with a sell signal. And the sell signal already occurred on the CCI a few days ago. So now the CCI is on its way to crossing the zero line. That is also known as the momentum line. Usually what we see when that line crosses is we generally see a continuation of the move in the direction of the cross. So if it crosses below the momentum line, we're expecting 2 to 4 more days of downward momentum. And so that's why I'm keeping that downside target right there on the diamonds at 437.55. Moving along to the Russell, which is the Russell 2000 ETF, ticker symbol IWM. We're moving quite nicely down towards that target of 233.20. We have the sell signal on the stochastic, and we are about to cross over the zero line down there on the CCI. So you can see how powerful that tool is for managing risk and picking your targets. One thing I want to point out is that if you notice the CCI high from this time earlier in November, we had a high and then followed by a much higher high on the price action, but notice the highs, how they're dropping on the CCI, and they're also dropping on the stochastic. That's known as a negative divergence. And I want you to remember that if you could as we get to the end, because I'm going to comment on Bitcoin, and we're seeing some pretty significant divergences on those charts as well. So again, to reiterate, downside target on IWM is 233.20. Moving along to the Qs, it's a tech sector. I did say we can go a little bit higher before lower. That's exactly what's happening. But look at that. We have a bullish candle on a negative divergence on the CCI. So what's happened here is that while the price action went up today, the CCI dropped. Now, we also have a negative divergence here, and it's very similar to what we saw back here. Look what happened after the negative divergence occurred in October. We dropped. And you'll see that over and over again. Here's a negative divergence here in the CCI on a higher price high. And again, we dropped. We have a gap down below the market. We have that moving average with a wide divergence from the price. And that downside target, while it might seem extreme, is still set down there at 492.79. So that is the Qs. SPY is going to be very similar to what we saw in the Qs. We had a slight update today. But again, negative divergence on both the CCI and the stochastic. So again, you see that we're up a fraction of a percentage, but the stochastic is still heading lower. Notice also that we're seeing the drop in volume as the price action is going higher. If you're a brand new subscriber to this channel, understand that each and every week I try to put out some sort of educational content so that you take this as a financial trading vitamin and learn something with each new video. So if you're liking this content, please hit the like button. You could subscribe. Also hit that notification button, because we put out the quick chart every Tuesday morning through Zero Hedge, and you, by clicking on that notification bell, can get first dibs at that forecast when it comes out on Zero Hedge. So you're more or less beating the crowd to the market. So downside target on SPY still in place at 581.22. Look at that massive gap that's still staring us down. That is something that cannot be ignored. And if I take a step back and look at SPY, look at that divergence and these negative divergences here on the monthly chart. Pretty incredible. This market is so overextended. And as we come into the year-end rally, also known as the Santa Claus rally, is only a 7-day window. It's the last 5 trading days of December and the first 2 trading days of January. And so what's happening here is that we have investors and traders trying to beat the rush into that 7-day window and trying to get ahead of the buyers. The problem with that is the market is already overextended. So after we go through those first couple of days in the new year, I would not be surprised at all to see some selling and maybe even some tax selling as people are trying to defer the tax on capital gains for 2025. They want to defer that into the next year. So look again at that curve here on the stochastic. We are heading lower and we are a fraction away from the sell signal showing up there on the CCI, which means that once it drops below the 100 mark, which is that red line, the sell signal is generated, and that's when selling is triggered on those crosses. You see back here, we see the sell-off that occurred after the sell signal here, and you can see after the sell signal there, we took a nice hit in the market. So I'm expecting the same thing to occur. Now, I often get messages and comments on social media from those who believe I'm a perma bear. I am certainly not. I'm a technician and I'm just reading the technical charts to you, while at the same time, we balance our positions. The majority of the positions we hold are still positive delta. As option traders, that means a long position was still bullish on the majority of our trades. But in the next couple of weeks, we're going to be rolling for cash in option spreads that are paying us out each and every month. So as an option trader, we're going to make money on the way up. We'll make money in a sideways direction, and we'll make a little bit more money on the way down as we change our positive delta positions to negative delta positions. We could do that with the click of a mouse. And we, again, follow the 7-point trading checklist for making these decisions. So if you want a 15-day free trial and have access to the webinars where I show everyone how to use the 7-point trading checklist, come on over. There's a link in the description box. It'll get you to a free membership. We don't require any kind of payment or credit card or anything like that. We don't play those games. It's a free 15-day membership. At the end of the 15 days, it just expires. You don't have to call anybody. It just goes away. And if you want to subscribe, obviously you can continue on, but it's absolutely free. And we don't have any high pressure sales teams that are going to be pounding you for, the credit card number. It doesn't happen that way here at Sticky Trades. So again, SPY, I have a big downside target down there towards that gap fill, which is right there at 581.22. Moving on to the VIX, very interesting. Remember that for the most part, the VIX is inversely related to the S&P. We have a bearish engulfing candle right there, which means we could go a little bit lower on the VIX as we test the support level that is from back here. Now, we're approaching all-time lows on the VIX. Remember what I just said. For the most part, the VIX is inversely related to the S&P. So if we get a bounce off of this historic low to higher levels on the VIX, what does that mean for the S&P? It means much lower prices. There's no way that I could take a confident bullish stance and tell everyone, oh, everything is good, we're staying in this bull market when the VIX is reaching historic lows. It's just not a wise thing to do. As a technician, I have to put the caution flag out there to those who are long and hoping that they are going to protect their positions or at least protect the profits. The other thing is if you're thinking about taking new long positions at record highs, again, I would raise that caution flag and tell you, be very, very careful, use risk management technique, use the 1% rule that I promote, and above all, make sure you're using stops to limit the loss should the market start turning against you. So I still have an upside target on the VIX all the way up here at the gap fill at $20.20. And I can give you a guarantee that one day that gap will fill. Why can I give you a guarantee? Because all gaps fill on the VIX because it's an oscillating index. It's not a trending equity or a currency. It just goes up and down within a wide range. And so that will eventually fill at 2020. All right, now I mentioned Bitcoin to you. Let me get to that real quickly. You can see we're screaming over 100,000 for the Bitcoin. I do not own any Bitcoin. Remember that I do trade Bitcoin related stocks. That's part of our membership and our trade publications that go out. So if you're a member, you know how I'm trading Bitcoin or the Bitcoin related stocks. And if I look at that monthly chart, look at that. We have a spinning top. Now we're only in the first week of December here, so that volume bar will grow. But remember what I said about the negative divergences. The last time we had something like this, we had a much higher price high back in 2021, but the highs on the CCI and the highs on the stochastic were dropping. And when you see that, brace yourself, because that's when the big sell-offs take place. If you ask any chartered market technician, they're going to tell you the same thing. Negative divergences are absolutely not bullish. Most of the technicians out there will measure the price against the relative strength index, also known as the RSI, but they look for these divergences and they are extremely bearish. So what do we have here? A much higher price high on Bitcoin with a super wide divergence, a record divergence, I might add, from that 20-month moving average, with negative divergences down here on the oscillators. So watch out below. You might have caught one of my zero hedge articles on some other stocks that were super overextended, like MSTR and Rocket Labs and such. Well, this coming Tuesday, again, making sure you hit that notification bell. You'll get notified before the article even hits Zero Hedge. That video will come out at 8:45 on YouTube, and you'll be notified before it gets published on Zero Hedge. But I'm going to be talking about Bitcoin next week, and by then, I think on Monday morning, you might already start to see some selling in this crazy cryptocurrency market. Again, look at that wide divergence. We call that the rubber band effect. You see that? Well, moving on to the economic news, remember that I follow the 7-point trading checklist. It's basically looking at all the signals. We look at the type of candle, we look at the volume, we look at the wide divergences like I just did in Bitcoin, we look at the gaps like we saw in the S&P. I measured the stochastic and the oscillators down below, known as the CCI, and we look for those negative divergences as well. And you can see that we have a role reversal that I often talk about, where once resistance is broken, we see the price often pull back to the breakout point, and then the former resistance turns to support. It looks something like this in more or less a stick figure example, where resistance, again, broken right here at the resistance line, often turns to support. So when you have wide divergences from the moving averages, we generally get the price drop back to the breakout points, and that's exactly what we're expecting here in all markets. All right, now moving on to the economic news. This week, we had the ISM, which is the Institute for Supply Management, revealed their report, which is a survey on the PMI, which is the Services Purchasing Managers Index. It dropped from 56% to 52.1%, which is a dramatic drop. You could see here the forecast was 55.7. That was a huge miss. Now, what is this survey? Well, it's something that is considered to be a leading economic indicator. The survey is asking these purchasing managers to more or less rate the relative level of business conditions, which includes employment and layoffs and such, and we'll get to some numbers there that are pretty telling. But this is a leading indicator that has been widely ignored to this point. I'm surprised we didn't see a bigger drop after this report came out, but we tend to see the bulls still coming in with no concern for economic leading indicators such as this. In addition to that, if you look at what happened here with the unemployment rate, please understand that recession and unemployment go hand in hand, and they more or less reinforce each other. Look at the number that came out on the unemployment claims, a big dramatic increase. That is very, very recessionary. The financial media is just not going to highlight any of this. And if at the very least I get people to think about the possible downside in an effort to help people protect their profits, then my job is done. Again, I'm not raining on anyone's parade, especially if you're an option trader. You know how quickly we could turn on a dime and start making money when this market starts to accelerate at the lower levels. Well, here is the most important chart of the day, and that is the percentage of total employment. Look at this. It fell to 3.3% in November, which is the lowest level since 2020. Isn't this incredible? So overall, the hiring rate has declined by 1.3%. And that in and of itself is the biggest decline in record. You see that in the circled area here. That's the biggest decline on record. And again, something that the market seems to be ignoring. This also puts the hiring rate much further below the 2001 recession levels. So while very few people even want to talk about the R word, recession, I believe we're already in a recession, and you will see that accelerate as the new administration takes place in January. I think they're going to dump all of that on Donald Trump. Not to get too political, but I think many people understand what I'm talking about here, where no one wants to be giving credit for the recession of 2024. So they're going to dump it on his shoulders in 2025 and let the dominoes go down. Outside of the pandemic, we're now seeing the biggest drop in the hiring rate since 2008. Think about that. The 2008 crash resulted in the market dropping 50% in 12 months. Let that soak in there for a little bit. 50% of the market's value was lost in 12 months. So I still have my sights on the long-term downside targets way down there, and I'm not moving from that until the economic condition gets a lot better. So in a nutshell, the U.S. labor market is absolutely freezing right now. All right, so like I said before, please make sure you click the like button. That helps us so much. Comments help even more. And if you subscribe, that's helping us build our channel. That helps to get our videos out on the algorithms that YouTube puts out. And of course, like I said, the notification bell, once you click on that, it will notify you when the videos go out right before it hits the airwaves on Zero Hedge and some of the other social media channels that we're marketing through. So you have a great weekend. Thank you so much. And I'll talk to you next week. So long.